now at roughly about 6.25, somewhere around in there, which is at a 3-year low. And that's a good thing for housing affordability, obviously. The lower the rate, the more mortgage payments are affordable. But it's not doing a lot to stimulate housing sales, because rates by historical standards relative to, say, 5-6 years ago, when rates were very low because of COVID, they're still much higher. So we have a lot of people that have mortgages that have very low interest rates and are not trying to sell their house or trade up or refinance because of that. My name is Brent Ambrose. I am Jason and Julie Borrelli Faculty Chair in Real Estate and Professor of Real Estate at Smeal College of Business at Penn State. Mortgage rates are set by the economy and factors that are taking place in the global financial markets. So there have been a number of moderating effects. Inflation has come down some, so that's causing the Fed to lower interest rates on their benchmark, and that's putting downward pressure then on Treasury rates. Mortgage rates are usually tied to the 10-year Treasury, and so the spreads, risk spreads for mortgage rates over the 10-year Treasury are coming down, and so that's why you're seeing some moderation in mortgage rates. Mortgage rates rose dramatically about 3-4 years ago as the Fed raised interest rates to combat the stimulus that had been occurring post-COVID, and to try to lower the inflation rate. Inflation had been escalating substantially, and so the Fed was trying to cool the economy by raising interest rates. And of course, as the Fed raises its benchmark rate, that affects all rates, and mortgage rates rose accordingly. And so we had rates up to 7% or so a few years ago. Since then, the economy has slowed down a little bit, and so there's now less pressure on the Fed to keep rates high, and so they have been slowly cutting rates. And as a result, we're seeing mortgage interest rates trending down as well. Historically, the mortgage interest rates are actually at a pretty stable level. I mean, if you go back 20, 30 years, they average around 6%. So we're kind of in that right around the average. We could see potentially rates dropping down to 5% level if the Fed continues to cut interest rates, or if the Trump administration plans to buy mortgage bonds comes to fruition. That would put downward pressure on rates as well, because it would increase the demand for mortgages. But I don't think we will ever see rates going back down to the 2%, 3% range that we had during the COVID period. As rates have come down, if you're looking to buy a home, that's good news, because that means that you can get credit at a lower rate. Your mortgage payment will be lower. That potentially will stimulate demand for housing. The drawback to that, of course, is that we are already in an environment where the supply of housing is relatively low, house prices are very high, and adding more stimulus, i.e. demand for housing, will simply drive up prices even more. So it's not clear that lowering rates is going to make housing more affordable, because prices will be going up as a result of the increase in demand for housing. So it's kind of a catch-22 there, if you will.